So our focus this week is on capital budgeting. So capital budgeting is the process of analyzing alternative long-term investments to decide which assets to acquire or sell. Now, this can be true for operational assets like property, plant, and equipment, and that's most of the time what we'll be looking at. But it can also be related to investments. So maybe investing in the long-term expansion of the business or something along those lines. So the objective for these types of capital decisions is to earn a satisfactory return on investment. And in theory, we want to look for the most favorable possible return on investment. So the process begins with managers submitting proposals for new investments in a plant asset. Then the capital budget committee is going to evaluate the proposals and recommend for either approval or rejection. And then finally, the board of directors or others charged with governance are going to approve the capital investments for the year. So capital budgeting decisions require careful analysis because they're usually the most difficult and risky decisions the managers make. Specifically, a capital budgeting decision is risky because one, the outcome is uncertain. Two, large amounts of money are usually involved. Three, the investment involves a long-term commitment. And finally, the decision could be difficult or impossible to reverse, no matter how poor it turns out to be. So we may not be able to get out of it. Risk is especially high for investments in technology due to innovations and uncertainty. Now, managers use several methods to evaluate capital budgeting decisions. Most methods use expected future cash outflows and inflows. An investment begins with an initial cash outflow to buy the asset. Over the asset's life, the asset's going to generate cash inflows and cash outflows. Inflows would be from additional sales, and outflows would be from cost, stemming from the asset. At the end of the useful life, some assets can be sold for salvage value, which provides another cash inflow. Some may not have any salvage value. So we're going to look at a variety of different techniques that management can use to make capital budgeting decisions. And in this video, we are just going to do a fairly high-level overview of some of the more common methods. So let's start with payback period. The payback period is a method used to evaluate investment decisions by measuring the expected amount of time to recover the initial investment. Managers prefer assets clearly with a shorter payback period because that reduces the risk of an unprofitable investment over a long period of time. The formula is super simple. We simply take the initial investment and we divide by the annual net cash flow associated with the asset. So let's look at a fairly simple example here. Here we're looking at the payback period for an investment that's going to have equal cash flows, okay? So the initial investment's going to be $16,000. So this is for some sort of machine that we are buying here to help this company with their operations. It's going to cost $16,000. We're going to use it for 8 years. There's no salvage value. This machine should be able to generate 1,000 units of sales per year. Material, labor, and overhead costs outside of depreciation are going to be $16,500. The depreciation is $2,000. Selling, general, and administrative expenses are $9,500, and the selling price per unit is $30. Okay, so we know what our initial investment is. Okay, the initial investment is pretty easy. They give that to us, $16,000. Okay. What becomes a little bit more difficult is determining what is the annual net cash flow. That's where all of this other information comes into play, okay? So now remember, we are looking at cash flow. That's why it was important to separate depreciation out of the other costs, because we know that depreciation is a cost allocation. It is a non-cash expense. Okay, so that's important. All right, so here we're going to look at the annual results associated with this machine. We're going to look, we've got an income column and a cash flow column. All right, so again, we're going to get 1,000 units out of this machine, and we're going to be able to sell those units for $30 each. That's $30 worth of income, and we're going to assume that we can collect all $30,000 of that money. Okay, so income and cash flow are the same for that. Positive 30,000. Now we're going to subtract out our expenses. Okay, subtract out 16.5 from income and 16.5 out from cash flow. That's for the material, labor, and overhead, excluding depreciation. All right, next we count depreciation, because depreciation expense is going to reduce income, but it is not going to reduce cash flow. Okay. Selling general administrative expenses, $9,500 under both columns. So from an income perspective, this asset's going to generate an extra $2,000 per year in income, but it's actually generating $4,000 in extra cash flow. So that becomes the denominator in our equation. Thus, under the payback period method, it will take 4 years for this machine to pay for itself. Okay, in 4 years, it will generate enough cash flow that it exactly offsets that initial investment of $16,000. Okay, so let's look at the advantages and disadvantages of the payback period method. Pretty much the big advantage is it's easy. Okay, it's really, really easy. The weakness is it ignores cash flows after the payback period, and probably the most significant disadvantage, and the reason that very few companies use it in practice, is it ignores the time value of money. Okay, so the payback method is kind of what I would call maybe like a quick and dirty method. You know, if you're trying to get a ballpark idea of whether something is feasible, then it might make sense to quickly run a payback period calculation on it. But if you're trying to get a more accurate result, payback period is probably not what you want to go with, because it does ignore the time value of money. And especially when we're dealing with long-term investments, that can make a big difference, okay? So let's look at another method that might be used, the accounting rate of return. This is going to be an investment's annual income divided by the average amount invested in it, okay? And so here we see an example of with the formula for the average investment, okay? So we take the initial investment plus the salvage value, okay? And in this case, remember the salvage value was 0, okay? And then we're just computing a simple average here. And so simple average is 8,000, okay? Under the accounting rate of return, instead of taking annual cash flow, we're going to take annual income, okay? Remember, when we computed income and cash flow, they were a little bit different. We had 4,000 in cash flow, but only 2,000 in income, okay? Because remember, for income, we also had to account for that depreciation expense, okay? So our annual income is only 2,000. We divide that by the average investment, which is 8,000, and that gives us 25% as our accounting rate of return. Okay, so let's look at the weaknesses associated with the accounting rate of return. It also ignores the time value of money. Very problematic. And it also does not directly consider cash flows and the timing of those cash flows. So let's look at a method that is more commonly used. Net present value. Net present value is a very, very commonly used method because it does take into account the time value of money when looking at future cash inflows and cash outflows to assess the viability or desirability of a given project, okay? So the net present value is essentially the discounted future net cash flows from the investment at the required rate of return less the initial investment. A company's required rate of return, sometimes called the hurdle rate or the cost of capital, is essentially an average of the rate the company has to pay to lenders and investors, okay? So it could vary from company to company, depending on what their rate is, okay? So here we're going to look at a very simple example. Companies considering a $20,000 investment in a machine that's going to provide $10,000 in annual net cash flows for 3 years. The company requires a 9% annual return, okay? So 9% is key, okay? Now, what we're going to do is we are going to multiply those cash flows by their present value factors. Okay, you can find present value factors many ways. You can locate them in your textbook. You can locate them online. If you just Google time value of money tables, you'll find PDF charts that you can download. They'll all be the same. You can use a financial calculator. You can even use Excel to do this. But essentially, we're going to determine the present value of each of these. Now, what you're going to notice here is present value of each of these gets smaller and smaller. And you say, well, why? Why is this $10,000 at year 3 smaller than this $10,000 at year 1? That's where the time value of money comes into play. Money received in the future is going to be worth less than money received today, or money received 3 years out is going to be worth less than money received 1 year out. And the theory is if we were holding that now, we could invest it and potentially get, in this case, a 9% return, but we're not. We're giving that up by having to wait 3 years. Okay, so that's the whole theory of net present value. Now, in this case, the net present value ends up being $5,313. When you're using net present value, in theory, if the net present value is positive, the project should be accepted. If the net present value is negative, the project should not be accepted. So we're looking for something with a net present value that is positive, that is greater than 0. That means we believe that the net present value of the future cash flows are going to be greater than our investment. Okay, and so it is going to yield us at least that amount of return that we're looking for, which in this case was 9%. Okay. Internal rate of return is fairly similar to that, except we kind of back into what we're looking for. In this case, we are going to take the present value factor equals the initial investment divided by the annual net cash flows, and then we are going to identify the discount rate yielding that present value factor. Okay, and we can compare that to what sort of rate management demands for investments. If the rate that the project is going to yield is greater than what management demands, that is greater than the internal rate of return, then it would be acceptable. If the project will yield less than that, then it is not acceptable. Okay, so here we see a very quick comparison of those 4 methods that we've talked about. Basically, the payback period is the simplest method. Again, it's not commonly used because it ignores the time value of money. Same thing with the accounting rate of return. It's simple, but it's not that commonly used because it ignores time value of money. Net present value considers all net cash flows from a project. It can be applied to equal and unequal cash flows, and it can reflect changes in the level of risk over a project's life. Because net present value is in dollars, comparing projects with different initial investment amounts can be difficult. So the profitability index is often used sort of in an accompaniment to the net present value method to kind of help to account for that. The internal rate of return considers all cash flows from a project, but because internal rate of return is a percent, it can be used to compare a project with different investment amounts, but it does not reflect changes in risk over a project's life, okay? So that's kind of a very quick overview of some of the advantages and disadvantages of each of these approaches. So I hope that this very short lecture has been helpful for you, and I hope that you feel better prepared to tackle the materials this week.